Get the full global macro and markets picture with Capital Economics' all-access packages. CE Essential gives you full access to all of our award-winning written analysis, all of our online briefings, and a host of critical data tools. And for deeper engagement with our Economist team, our proprietary data, and seamless integration of that data into your workflow, CE Advance is our most complete solution. Go to capitaleconomics.com today to learn more about CE Essential and CE Advance.
It's Thursday, 9th of October, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, where next for the dollar and what just happened in Japanese markets. But first, Neil Shearing joins me on the line from New York, where he's been meeting with clients this past week. Hi, Neil. I see you haven't managed to get the government reopened since you've been there.
Government still shut, airport lines still crazy long, but a good week of meetings nonetheless.
Good. I think you've got about 24 hours before your flight, so see what you can get done. I mean, look, you were saying last week that government shutdowns don't tend to have a big impact on the US economy if you look at the charts. What does have an impact, though, it's trillions of dollars in AI investment. I do want to get straight into this because I know you've been getting lots of questions about this. Is AI a bubble or not? All week, I know our US team got it several times on their drop-in that we held on Thursday for clients. I see the S&P futures are up again as we're talking. But if you took the big tech stocks out of the stock market, its returns don't look nearly as impressive. What have you been telling clients in terms of what the broader economy looks like, if you take away AI? I mean, is it all about AI at the moment?
Well, you're right. It's really striking that this week, seeing clients in the US, a lot of the questions have focused on AI. There's been almost no discussion of trade and tariffs. It's like we've kind of forgotten Liberation Day ever happened. And the focus now very definitely on AI. And partly, you're right, that the market implications of all of that. But in particular, the macroeconomic consequences of AI. And the question that keeps coming through is, to what extent is AI the sole prop of the US economy now? This AI boom, is that the only thing that's driving economic growth in the US? I think the answer to that is no, it's probably not the only thing. Now, a lot of the analysis that leads you to the conclusion that this is all AI tends to start with something like investment in IT hardware is growing at 20% year on year. Investment in IT software is growing at just over 10% year on year. Investment as a whole contributed a 70% of GDP growth in Q2 and Q3, something like that. And that gets everything wrong. It muddles everything up. And the reason it muddles things up is because a lot of that investment sucks in imported components. So if you think about a lot of the components that go into, say, data warehouses, many of those components are produced outside of the US. So you need to net off the imports. And of course, we've seen an import surge in the US too. Doesn't help President Trump's goal of trying to close the trade deficit either, does it? So if in a direct sense, I think AI has contributed less or been responsible for less of the GDP growth in the US over the past couple of quarters than many assume. What has been a key driver of economic growth, particularly on the supply side, has been a pickup in productivity growth in the US. And this separates the US out from other advanced economies. Now, part of the capital deepening associated with AI might be feeding into a pickup in productivity growth, but I suspect it's also the case that firms are simply working existing employees and capital harder in the face of an immigration clampdown that squeezed labour supply and a policy agenda that's made the outlook a bit more uncertain, and so perhaps stalled some plans to hire workers. So I think when we look at the outperformance of the US, and the US has clearly outperformed relative to other advanced economies, is principally on the supply side about a pickup in productivity growth. Some of that may be AI related, but I think a lot of it is probably about firms just working existing employees and capital a bit harder.
Based on what you're saying then, if there is this massive burst of investment in AI, if that cools, because really that is the big question, isn't it? These hyperscalers, if their spending on CapEx turns down, how much will that affect US economic outlook?
Well, again, it will have an impact, but it will reduce investment, but it should also reduce imports as well. So the direct impact would be a bit more limited than you might suppose from just looking at the headline numbers on, say, hyperscaler CapEx. Now, the question is really, is that going to happen or is that imminent? And if you look at the stated plans of the hyperscalers, Actually, if anything, they're intending to step up investment over the coming quarters. And from a historical perspective, we're still in the early foothills, I think, of this investment boom. Not the financial investment boom, the capital investment boom around AI. So my sense is that there's a bit more life left in this capex boom in the US. If you look at our forecasts in our latest US economic outlook, which we published over the past fortnight, we envisage business investment in the US growing at about 5 to 6% a year over 2026, 2027. So gives you a sense of just how strong business investment is likely to be in an economy that's growing at about 2 to 2.5% a year.
I want to come back to what you were saying about how, Liberation Day all feels like a distant memory, not much talk of tariffs, not much talk of inflation risks in your conversations, because at least some of the recent mood shift in markets, in the near term at least, has been around this Fed pivot. We're not going to get CPI or PPI releases next week unless the US government reopens. But is there a sense of a complacency around the inflation outlook, that tariffs didn't bite as much as expected? So the genie, if it's not back in the bottle, at least it's circling the bottle. But actually, we have yet to see the full impact of tariffs. And actually, this complacency is going to get caught up short.
Well, I think it's true that we've yet to see the full impact of tariffs. When we look at the impact of tariffs, say, on inflation, it's very difficult to discern a substantial impact. Now, normally, core goods inflation in the US is somewhere between 0% and minus 1%. It tends to be kind of flat to a bit negative, and services inflation in the US and other economies tends to be a bit above target. That tends to be how the different items within the CPI basket, the prices tend to evolve. Now, if we look at core goods inflation in the US, is currently running at around 1% year on year. So it's having been 0 to a bit negative before tariffs. So there's some sense of it. There's some evidence that tariffs are feeding through and creating a bit of goods inflation. I don't think that's run its course fully. In our forecast, we've got a bit of a further pickup in core goods inflation over the coming months, partly actually because we've yet to get to the peak effective tariff rate that we envisage. So if you look at all the announcements and deals that have been done on trade and tariffs, that would give you an average effective tariff rate of about 16 to 17% in the US, a bit higher if you include pharmaceutical tariffs. Yet, if you look at the duties that are being collected at the border and divide it by the amount of imports that are coming in, actually the effective tariff rate's a bit below 10%. So that reflects the fact that there's been some rerouting and maybe some forestalling of these tariffs going on. So we've not yet got to peak tariff rates, and there's a bit more inflation to come through, I think, as firms start to, rather than absorb tariffs in their margins, pass them on to consumers. The question is, what impact does that have at a macro level? And my sense is it's probably quite limited. I think the idea that the sky was going to fall in because of these tariffs was always a bit overdone. The US, as we've talked about on this podcast, is a large, relatively closed economy. Goods imports about 15% of GDP. So there might be another kick up in goods inflation, say from currently running at just over 1% to say close to 2% a year. Services inflation comes down a bit because in our forecast, shelter inflation comes off. Headline inflation stays broadly where it is. I don't think this is a kind of economic Armageddon, even if we've not yet seen the full impact of tariffs.
Broadly, there's a good news story to tell about the US, and it contrasts with what's been happening in Europe. I know you highlighted that contrast on the podcast last week, but we are once again now between French prime ministers. Sébastien Lecornu went at the start of the week. He was the third in the year. Reports say that the fourth PM could be named in the next day or so. How much does what's happening in France speak to this broader malaise around economic underperformance in Europe, basically since the global financial crisis? Another way of saying it is, if the UK and the French economies, and indeed the sort of the core European economies, were growing at trend, or at least had articulate growth plans, would there be such anxiety around their debt situations?
I think that's a really good way of framing it. And the counterpart to that, if you like, is that we often get asked the question, if increasingly been asked the question, indeed this week I've been asked the question, is this a kind of Eurozone crisis 2.0, as it were? And I think one way of thinking about that is that what went wrong in the Eurozone crisis in 2012 was that economies lived beyond their means. Economies as a whole lived beyond their means. So it wasn't just the Greek government running a big budget deficit. Greece ran an enormous current account deficit too. It's consumed more than it produced. The situation today in Europe is very different. France has an enormous fiscal problem, budget deficit, 5% of GDP, debt, 130% of GDP. But the current account deficit, the current account is in balance. The economy as a whole is not consuming more than it produces. So think about it a different way. Public sector dissaving is being offset by private sector saving. So this is not an economy that's overheating. It's not an economy where balance sheets outside of the government need to retrench and be repaired. It's a fiscal repair job that's required. So I think that gives you some hope that there's not going to be a big collapse in the private sector in France and the French banks in particular as a result of these fiscal problems. Is more a case that rather than economies overheating, the government's lived a bit beyond its means. And because growth is weak, tax receipt growth has been weak, and real interest rates are no longer been negative, that's made the job of repairing the fiscal situation, the public finances, more challenging. So yes, in a sense, the problem is not that these economies are overheating and we're living beyond their means and there needs to be a painful correction. It's that actually growth's been quite slow and weak and sluggish, and that's weighed on tax receipts, and it's making the job of the fiscal repair job harder.
Which isn't to play down the challenge, right? I mean, frankly...
No, absolutely not to play down the challenge. And of course, the rejoinder to that point, or someone who was perhaps a bit more kind of pessimistic would say, well, that's all very well good saying that. Greece was a relatively small economy in the grand scheme of things within the Eurozone, but France is Europe's second largest economy, and from a political perspective, obviously absolutely central to the Eurozone project. And these fiscal struggles and problems of weak growth are giving fodder to populists, not just in France, but across the Eurozone and Europe more generally. So it's certainly to play down the problem. And when the fiscal adjustment happens, it's going to require some degree of austerity. The spending has to be squeezed, or tax rates are going to have to go up, and that will weigh on private sector demand. Rather, my point is that French banks don't own a whole load of French government debt in the same way that Greek or Italian or Spanish banks did back in the 2010s. So there's less of a doom loop that's going to develop, or less risk of a doom loop developing through the banking sector. And the private sector as a whole is not living beyond its means. So it's not like the whole economy needs to undergo this big adjustment. It's just the public sector that needs to retrench. So it just, I think, tempers the idea that France is on the brink of economic crisis. The fiscal situation is a mess, but the economy as a whole, I don't think, is kind of about to tailspin into a crisis. More likely that it's just going to continue to experience sustained weak growth, and that's going to continue to make the fiscal repair job pretty hard.
So before you go, big story today is new controls on exports of rare earths imposed by China. Statement came out just a few hours ago. I know relations between the US and China seem to have calmed in recent months. There's been this concerted effort to keep dialogue going, achieve some kind of progress within the bilateral. This latest news, it suggests, doesn't it, that trying to maintain that even keel is a tricky task, right?
It's incredibly difficult, and you're right that there's been more positive signs, warm noises coming out from the leadership in both countries. Clearly, Xi and Trump are trying to push towards some kind of deal over the coming weeks and months. Clearly, Trump in particular, but Xi too, are trying to push towards some kind of deal. But you're right that it's not just rare earths, actually. These rare earth controls that have been tightened. If you look at what's happening kind of at a lower level, for example, the US a couple of weeks ago expanded its so-called entity list that restricts the ability of US firms to transact with China, and expanded that in a way that actually makes it much more difficult for some firms to do business with firms in China. So yes, there's warmer noises coming out at a leadership level. Further down, the policies are still pushing towards this factoring that we've talked about and I've written about in the book. And my sense over and above all of this is that even if we do get some deal between Trump and Xi over the coming weeks and months, and I think that's possible, even likely. The question is, what does it amount to? If you look at what China committed to doing as part of the phase 1 trade deal in Trump's first administration, it got nowhere close to buying all of the goods from the US that it said it was going to as part of that deal. So I suspect that a phase 2 trade deal will do something similar. So yes, warm noises coming out at the leadership level. Yes, I suspect there's a good chance there'll be some kind of deal done over the coming weeks and months, but there's a big question as to what that amounts to in practice. And these rare earth controls that we've seen announced over the past 24 hours are further evidence of that.
Neil Shearing there on AI, French political turmoil, and China's move against rare earth exports. Since we recorded that, the New York Times is reporting that some BLS staff are being recalled to finalize September inflation. No word on when the reports will come out, but the thinking is it'll be before the Fed meeting at the end of this month. So stay tuned and we will bring you the analysis as soon as it's released. On rare earths, our China team has a note out with more on Beijing's motivations. I will add that to the podcast notes as well. Neil mentioned his book, The Fractured Age, that was published over summer. It brings together a lot of the work that's been going on at Capital Economics over the years on this issue of global fracturing. On AI, I will add a link to the podcast notes to a recording of that US drop-in. That's one of our short-form online briefings, as there is much more discussion in that about the economic impact of this technology. And in terms of the market's impact, we've just released our latest asset allocation outlook. That makes the case for equities continuing to rise on the back of hype around AI. I'm going to be talking to the markets team about that in a drop-in that's happening this Wednesday, and I will link to that briefing in the podcast notes as well. For access to all of our online briefings and all of our macro and markets coverage, don't forget CE Essential and CE Advanced give you the complete package, along with a host of data tools and options for engaging directly with our team of economists. Get in touch with us, sales@capitaleconomics.com, and we can set you up with a trial to either of our all-access packages, so Essential or Advanced, pronto. Now, staying on markets, Neil and I mentioned Liberation Day. That was back in April when Donald Trump unveiled eye-wateringly high tariff rates on the global economy from the Rose Garden. It triggered panic throughout global markets and helped feed this narrative about US institutional decline and the end of the dollar's role as the anchor of the global system. 6 months later, how is the dollar doing? To find out, I spoke to Jonas Goltermann, our Deputy Chief Markets Economist, and I started by asking whether all this talk about the death of King Dollar was overdone.
Well, yeah, I think that's fair. You roll the clock bach to April, there was a lot of drama, but in the end, then there was a big fall in the dollar, value of the dollar, but it's stabilized and certainly doesn't look like the much anticipated death of the dollar has been postponed yet again. I don't think we're necessarily all the way back to normal service in currency land, but interest rate differentials have done a much better job of explaining exchange rates since, say, June, July time than that sort of turmoil period in April and March. So a lot of that messiness and the dissonance has faded. I think, it now looks like it was more a question of a big shift in hedging behavior among European, Asian, Canadian asset managers. And it became a bit disorderly. Partly it was a response to Trump and his policies. I think also everyone can realize that they were a bit in over the skis on the US exceptionalism trade and wanted to diversify a bit. But yeah, over the past 3 or 4 months, it's been pretty stable. The dollar's up a bit this week. Net over the past 3 or 4 months, it's been stability, bit of a pause for breath. Now, the consensus still seems to be that there is another big leg to come, possibly into year end, maybe next year. Certainly, I wouldn't dismiss that entirely, but I actually think that the more likely outcome is that there is a bit further of a dollar rebound over the next few months. We think the US economy and stock market is going to keep holding up well. Not necessarily US exceptionalism in the way it was the past couple of years, but US still looks a better bet than most other major economies. We don't think the FOMC is going to cut as far as the market now discounts. That'll help the dollar. And increasingly, if you look on the other side of the coin, Europe especially, it looks at that whole new dawn narrative that we had at the start of the year that's turning into yet another false dawn for Europe. Now, the other thing that we've had with the past few months is access to the slower moving data on flows and dollar holdings and so on from the IMF, the BIS, and other sources. And that generally shows that there hasn't been a big shift out of the dollar by reserve managers. The dollar is still dominant in terms of market share in the FX market and transactions and so on.
How do we square the idea that, the dollar's moving sideways after that April sell-off with what we're seeing with assets like gold and Bitcoin hitting these record highs recently, and this narrative that, this shows investors have lost faith in the US government as an issue of this currency?
Well, I think that narrative certainly is interesting, but I think it's been massively overblown. I don't want to dismiss the argument entirely, because there certainly is a strong desire out there, and we hear it from clients as well, for alternative stores of value, diversification from the traditional safe havens now, whether that's gold or other metals or real assets of any kind or crypto. Those prices do keep going up. At the same time, treasury yields are down, so it's not like there's a flight out of US treasuries over the past 2-3 months. If anything, the reverse. Nor, as we talked about earlier, is there been a continued flight from dollars. I think the better way to frame it is, yeah, sure, fiat currency in general, government bonds in general, don't look as good a bet, as less of a sure thing than they have done in the past 2-3 decades. But the price of gold is at record highs in every currency, not just the dollar, what's the biggest fiat currency. So, but the way I would frame it is questions around the desirability of fiat in general, of government bonds in general, not specifically the US. And I think it's also fair to say that there's a pretty big speculative momentum-driven dynamic at play in many of these markets, including gold. They're all relatively small and illiquid when you compare them to currencies and bonds. So it doesn't take a massive shift in demand to generate a big rise in prices. And that sort of dynamic, it can run for a while, often longer than you think is plausible, but it can also turn very quickly and go into reverse. So I think it's a case of buyer beware there.
How's the government shutdown affecting the mood? Because if nothing else, we haven't had any of the key economic data releases that markets rely on for direction, right?
Well, I think it's fair to say we're flying blind, or maybe with a part of the windshield covered at least, which is not ideal, especially right now. The US economy is at a kind of a tricky point in terms of the labor market and inflation, and that's where we rely on government data for both of those things. Now, past shutdowns haven't made much macroeconomic or market impact, so there's a degree of reassurance in that. Certainly, I think the consensus view is that this time will be the same in that respect, and so far that's been borne out. There's not been a big move in market, certainly on account of the shutdown. Now, maybe this time proves different with Trump. You never quite know. There is this talk about not providing back pay for furloughed government employees, which would be different from past shutdowns and the kind of thing that could generate a bit of a macro impact. But I think ultimately, this whole shutdown gambit, if it turns into a political own goal for either side, and I think they're still trying to work out who's winning and who's losing, that side that's losing will fold pretty quickly and probably before too much damage is done.
So this kind of dysfunction doesn't affect appetite for the dollar, or is it the case that, there's political dysfunction everywhere? Look at France, look at Japan. Really, the dollar doesn't look so bad.
Well, I think you're right. There's an element of, well, if the US was the only government showing signs of dysfunction, then that would be one thing, but it's far from being the case. It's as bad or worse in other major economies. You mentioned France and Japan. Obviously, you could add the UK to that list as well. The other thing is that shutdowns in the US are not new. They were a thing in the 90s under Clinton. They happened pretty much under most administrations since the 70s. And like I said, most of the time they only last a few days. This one is towards the longer end, but the longest shutdown was more than a month. So sort of some ways from that, it's certainly not a feature, but it is a part of the system more than it is a bug or necessarily a sign of dysfunction. Now, US politics certainly feel quite dysfunctional, but that's not new. It's not something that's going to drive a big sell-off off the back of this one maneuver. We saw earlier in the year, I think, the shock of the way that Trump is approaching government certainly played a part in the fall of the dollar and also the US equity market at that time, and treasury markets got a bit discombobulated. But The sense now is that the Trump administration has learned its lesson. That feels optimistic to say, but that there is a bit of a guardrail, and that courts are pushing back, but also the market will push back, and that the administration and the Treasury Secretary in particular will listen and will react to pressure from the market.
Let's move away from the US, because I have to ask about what we're seeing in Japan. It is all a bit uncertain at the moment, but Sanae Takaichi might become prime minister if she can build a coalition. Her surprise election to the head of the LDP last weekend saw this big jump in JGB yields, big jump in stocks, big move down in the yen. What does that whole market reaction tell us?
Well, I think it's pretty similar to what you saw back when Abe became prime minister. Obviously, it's on a much smaller scale so far compared to if you compare to the cumulative impact that Abe had. And certainly it was a big surprise to the market, because the expectation was that she wasn't going to win it, but Koizumi was heavily favored to take the leadership role. So one of those times when you get a big market reaction to political developments, because it's such a big surprise. And the parallels to Abe, they are fairly obvious and deliberate on her part. Our team in the region has done a great job, covering all the bases this week, really, with a series of updates on both the economic and market implications. And in short, as you say, the market is taking her largely at her word that she wants to be like Abe and do the things that he did: lose fiscal, lose monetary, structural reform, the famous three arrows, as it were. And the market reaction is mostly in that direction. A big rise in the equity market, as you said, a bit of a fall in short-term yields, but rising longer-term ones, and a much weaker yen. I think there's two key differences between now and when Abe took charge. One is what you mentioned: she doesn't have a majority in parliament. One of her coalition partners, long-standing coalition partners, just left the government, so there's a hurdle there to get past on the political front, which seems like it will slow things down at the very least, and possibly limit her ability to push through as much change as she wants. The more important difference is that the economic backdrop has changed a lot in the past, whatever it is, 12, 13, 14 years, both in Japan and globally. Abe came to power in a period of weak growth, deflation fears, and a very strong yen. His policies were aimed at addressing those challenges, and particular, he was trying to generate monetary easing at a time when it was thought that Japan was already effectively tapped out. It was at the lower bound of what rates could be, and couldn't achieve more monetary stimulus. And he proved that to be wrong, right? You can debate how much he achieved in his time in office, but he certainly proved the doubters wrong on that front. Today, growth in Japan is actually pretty decent. Inflation's high by Japanese standards, and may actually finally be normalizing after 3 decades below target, of near zero. The BOJ is in a tightening cycle, a very gradual one, but it's an actual tightening cycle for the first time in a long time. They're trying to normalize monetary conditions. The yen is very weak today because the rest of the world has tightened monetary policy much more than Japan over recent years. So where does it leave us with the market? Well, our assessment is that Takaichi, this change, will be a positive for Japanese equities. We've revised up our forecasts accordingly. It's less obvious what the impact on bonds and the yen will be, and whether it was similar to what Abe did. I think long-term JGB yields will probably keep rising as the BOJ tightens policy. We don't think that trend is going to change on account of the new government. It may slow a little bit, be delayed a few months, but it's not going to fundamentally change. It's what the central bank needs to do to keep inflation from getting out of hand, and more broadly to normalize conditions. And with the yen, I think it's going to be much harder for Japan to generate a big fall in the yen when it is already so weak. And I'm not sure it's really in the country's interest or the government's interest to even try. For one thing, it would mean more inflation, and the wrong kind of inflation, imported inflation, rather than driven by strong domestic demand. I don't think that would be politically popular either. Trade partners also would object, especially the US, given Trump's views on trading currencies. So the bottom line is we're sticking to our forecast that the yen will eventually rebound and appreciate substantially from here. Although, as with the BOJ story, it is looking more like a 2026 story than anything else.
That was Jonas Goltermann on Japanese politics and the yen and US politics and the dollar. On Japan, I will add some of the team's coverage to the podcast notes. This is a very fluid situation and the team are going to be watching closely, and we'll be holding a drop-in early next week to take your questions and give you the latest analysis, so watch out for that. Jonas will be joining that markets drop-in that I mentioned on Wednesday, so do join us for that. Put your questions to him about the dollar outlook and anything else markets related that's on your mind. But that's it for this week. We will be back next week with more from the front lines of global macro and markets. Until then, goodbye.